In the ever-evolving landscape of 2024, the financial world seems to be riding a never-ending roller coaster. But what makes this year different and how one can potentially grow wealth amid such volatility? Let's kick things off with a quick glance back at the astonishing journey we've had over the past year. The S&P 500 soared by an impressive 26%, hitting new all-time highs. Meanwhile, the housing market wasn't left behind, marking a remarkable 9-month surge to new record levels. And let's not forget about Bitcoin, which more than doubled, fueled by the anticipation of an ETF. Plus, a quirky tidbit, Tesla's tech is edging closer to sci-fi territory with its machines. Interest rates? They're starting to come down after a long stint in the sky. This could mean a lot. Lower rates could reignite spending and investment, but the path is as clear as mud. Politics can turn markets upside down, and if that's not enough to keep you on your toes, whispers of a government shutdown are floating around. If history's a guide, this isn't just a small bump on the road, but a potential pothole for the economy. But here's a reality check. While the market's been on a joyride, the average Joe's stock gains are barely limping past inflation. Rewind to 2014, and you'll stumble upon a Business Insider article shedding light on a curious phenomenon. Why do so many average investors struggle or even lose money, especially when market prices are on the rise? Here's some context. When article was penned, the S&P 500 had dipped to 1820, yet this downturn was actually a golden ticket, an ideal moment to invest. But what did the average investor do? They hit the sell button, sitting on the sidelines waiting for a sunny day in the market. This move meant they missed out on some of the juiciest moments of the decade. Now, let's sprinkle a fascinating fact. Over the last 20 years, there were about 40 days that really determined whether you were in the green or drowning in red. And here's another twist. The best performing days often follow the worst ones. Well, there's a classic. They buy high and sell low. Not exactly the golden rule of investing. The stock market is more of a marathon than a quick dash. If there's cash, you won't miss for decades. That's your ticket to ride. A steady climb is what you often see. Looking at the S&P 500's performance over any 20-year stretch in the last century, investors always came out with more than they put in. The worst case scenario? A modest 4% annual return. The best, a whopping 16% a year. Typically, you're looking at a comfortable 7 to 10% growth each year. Sure, short term, the market can be anyone's game. But long term, that's where the real winners are made. In the first year of investing, there's a 73% chance of making a profit. Stick around for a second year, those odds bump to 80%. Make it to 5 years, and boom, you're sitting at a 90% chance of profitability. Hit the decade mark, and you're practically golden with a 97% chance of making money. It's pretty clear. The longer you stay in the game, the better your chances of coming out on top. But hold up, what about election years? Historically speaking, during election years, October often sees the market dipping about 1%. But don't fret. Historically, November and December tend to pass things up, typically reversing any losses from October. And if we're diving deep into the history books, going all the way back to 1928, the market has risen in 19 out of 23 election years. Courtesy of market analyst Ryan Dietrich, whenever the S&P 500 dips by 10%, but then rallies back with a 10% gain the following year almost always ends up in the green. Plus, aside from a couple of outlier years, whenever the market jumps by over 20%, the next year usually sees even more growth. What's the takeaway here? Well, it strengthens the case for investing regularly, regardless of market prices, because historically, things tend to look rosier in the rear view mirror. This steady as she goes approach, known as dollar cost averaging, means investing a fixed amount regularly. Now switch gears to the housing market. The past few years threw everyone for a loop. Home buying became a dream for some and a distant memory for others. Low interest rates were great if you were already in the game, locking in deals left and right. But for newbies, prices soared, options dwindled, and then came the rate hikes. But here's where it gets interesting. 2024 is whispering promises of change. The buzz is all about the 30-year mortgage rates taking a dip. Why? Looks like the big players think Federal Reserve might cut the strings on interest rates not once, not twice, but possibly 3 times. The US Census Bureau dropped a nugget of info saying there could have been 740,000 more homeowners if we were playing by the 1990 rule book. What does that mean? Well, it hints at a bunch of potential buyers waiting in the wings, and when mortgage rates starts to dip in 2024, expect a buying frenzy. Now, industry forecasts are getting mixed signals. While everyone's dreaming of price tags shrinking, the general vibe is more about a slight price hike instead. Think about it. A median home price climbing up to $394,000. That's about a 1.5% uptick from last year. But real estate is like weather. It's all local. Big cities might see some chill with slight price drops, places like Miami or Los Angeles. On the flip side, cities like Indianapolis or Detroit might see their prices puffing up a bit. Here's where it gets juicy. The experts can't seem to agree. Redfin's got a hunch prices might take a 1% hit. Zillow's betting on a subtle 0.2% drop. Morgan Stanley, they're leaning towards a 3% decrease. And then there's JP Morgan playing the long game, thinking things might level out by 2027. Now onto Bitcoin, the digital gold rush of our era. Did you know that in 2023, its value shot up from $16,500 to a whopping $42,000? But hold on, before you jump on that bandwagon, remember, it's a roller coaster ride, complete with ups, downs, and loop-the-loops. Average investors sitting pretty because their buy-in average was around $33,000 are probably doing a happy dance. Even the big guns like MicroStrategy are seeing the light at the end of the tunnel with their investment back in the black. But where does it go from here? That's the million-dollar question. That's chatter about a Bitcoin ETF, but opinions are split on whether that's already reflected in the price or if there's more drama to come. The approach? Consider making Bitcoin a small slice of investment pie. It's like that old saying, don't put all your eggs in one basket, especially if that basket is riding on the back of a digital camel in the unpredictable desert of cryptocurrency. But here's the thing, investing isn't just about chasing the next shiny object. It's about strategy. And let's not forget about keeping a cash reserve for those once-in-a-lifetime real estate deals. As for the adrenaline rush, that's where the 5% earmarked for riskier ventures comes in. And here's a kicker. Despite all the new shiny investment trends, sticking to the basics has often paved the way to success. As we wrap up our exploration of 2024's financial landscape, it's clear that while challenges abound, so do opportunities. From navigating the shifting sands of the stock market to making informed choices about alternative investments, the key seems to lie in strategic planning and patience. What strategies will you employ to tackle this year's unique set of challenges? Dive into the comments below with your insights. And if you found value in this discussion, don't forget to like, share, and subscribe for more insights and updates.